Lindsay, thank you so much for joining me.
Thank you, Brian. I appreciate it. Good to be back.
Awesome. Let's just start super basic. What's Spartan Invest? What do you guys do? How long have you been
So,
doing it?
Spartan Invest, we are a full service turnkey company, and we are based out of Birmingham. We're actually in our office in downtown Birmingham on 3rd Avenue. So, we do absolutely everything for our investors. Most of our investors are in Southern California, Hawaii, places where it's really hard to get cash flow and a decent rate of return on investment properties. So we purchase the property, renovate it, then resell it to investors. And then we also have the property management company, Atlas Rental Property, that manages them after the fact. So essentially, we're the one-stop shop. We also have a new construction company, Corinth Construction. You see I'm wearing different labels. I've got a Corinth vest and a Spartan shirt. So Corinth is the new construction company that will also build and sell some to owner occupants, but primarily to investors and feed into Atlas Rental Property as well.
Gotcha.
So that's the business model.
No, and that's a lot. You're doing
It's a lot.
And that's why we want to talk to you, because you've got your hands dipped into a lot of different things, especially when it comes to Birmingham, not just Birmingham. I know you guys have branched out.
We're in North Alabama, but all central Alabama, Montgomery, Tuscaloosa, really kind of spanning all the way from Jasper to Talladega, North Alabama, Athens, Decatur, all of that. And then we also have a office in Chattanooga, Tennessee, and that services all southern Tennessee and then kind of the north area of Georgia as well, like your Rossville, Ringgold, all of those type areas up there.
And it's impressive to me from the outside looking in, who I was wholesaling you guys properties back in 2000, it had to have been 14 and 15.
14, 15.
So 10 years ago, I really got to know you guys, and just to see you go from this kind of upstart and just trying to get all your ducks in a row to what you've blossomed at. You're doing new construction, build to rent, you're doing all this stuff. So it's really, what changes have you seen over the last 10 years that are kind of most prevalent, especially when it comes to the numbers, like the cash flow, the rents, the prices of properties? What's kind of the biggest thing you've seen change in the last 10 years?
Well, honestly, just the prices in general. And that's going across the board from the amount that the properties have appreciated, and that Birmingham, just historically, we've lived in that 2 to 3%, area, and we sell that. That's very attractive if you're looking for stability when you're looking to invest in rental property. But the appreciation, we saw 8 to 11% appreciation over 21 to 23. So that has significant side effects, and that construction costs are up, maintenance costs are up as well. So this was the 6th consecutive quarter where construction costs have outpaced rental increases. So our investors are struggling with that, and we're working on trying to mitigate those costs, and that it costs more to have the house painted if you have a tenant do damage. So just the overall increase in everything, insurance costs, property taxes, that has pinched a lot of pennies over the course of the last few years. If you're looking at the last 10 years, that change has definitely been the most significant.
Just talk about Alabama, though, in particular. You just mentioned, we had that huge, spike, and some people call it, it was appreciation, it was inflation, a lot of it too. But just Alabama, since you guys have been doing this, do you feel like Alabama is kind of like a destination now that people want to buy rental properties here when it probably wasn't when you first got started?
Absolutely.
Just talk about that growth for a minute.
Yeah, that has been fantastic to see. In that when we first started Spartan Invest and the turnkey side, we'd have to fly our investors out here on our dime. They would not come. They were like, I'm not going to spend my money going out to Birmingham, Alabama. So that was one way that we had to really shove Birmingham in people's faces. And once they got here, they were always pleasantly surprised. But it did take a little bit more of the finagling and trying to push the potential growth with Birmingham. Now, Birmingham has done a fantastic job of moving that along on its own with infrastructure and bringing on the manufacturing jobs, Alabama as a whole. And so that growth has really helped put Birmingham and Alabama on the map. Now, of course, Huntsville being like one of the fastest growing cities, one of the best places to live. That's a hot market, and we see that on the demand side. Any investor that's coming to us, that's pretty much what they're wanting to talk about. They've read and heard a lot about Huntsville, and they want to talk about it. So Alabama's had a lot going for it over the last decade. It definitely wasn't that way to begin with, but it's been great to see that growth.
Has it been, I guess it's easier to find investors
Absolutely.
that want to.
Absolutely. Now, again, the last couple of years have been a little bit more challenging. We've finally seen that change over the last, or I'd say over 2024. We finally saw, I think, more just rate acceptance with investors. In Birmingham, in real estate, it's very cyclical, and there's ups and downs, and the Fed obviously pushing interest rates hurt all turnkey providers, anybody that was looking. I think investor activity was down 40% overall, just in general.
Wow.
And so we definitely were no different in feeling the effects of that. But again, we've seen that change. We're shifting more back to kind of a normal-ish market, knock on wood.
Yeah. No, what do you mean by normal-ish? Because interest rates are still
very high, but I think the rate acceptance in that investors are finally coming to terms with, hey, it's not ever going to go back to 2%, 3%. Now, sorry, I didn't mean to cut you off, but we're also spending thousands and thousands of dollars on buying the rates down too.
Okay, so that's what I was going to ask you. You're talking about rate acceptance. Can the properties even still cash flow? I think that's obviously the most important thing to an out-of-state investor. We want cash flow here. How have you guys maybe struggled and then kind of gotten through that struggle of, hey, these properties are still cash flowing and here's how they are?
Right. So, and even at the highest rates, like even when you're looking at 7.5%, and again, you know this, you've been doing this a long time, you know that if the deal works, it works. It doesn't necessarily matter what the interest rates are. So as they increased, obviously we had to meet that with a lower price to ensure that there was still a decent return and that there was cash flow. But again, still it's really hard to get that mindset away from interest rates with investors, and that it had been pushed for 2.5 years of like, hey, the rates are really low. I mean, our sales team was just order takers. We didn't really have to push our properties. They were just flying off of our site. But then to counter that as well, we've been doing the forward commitments. And that's where most home builders offer this, and where they're buying down the rates in bulk. Well, we started doing that for our investors as soon as lenders made it available, just to large single family sellers. And we're buying like $2 million of loan amounts down in a single time. And we can't do, like, you wouldn't be able to buy it down to what we're buying it down to.
So what is that? I know kind of on the surface what that means, but what is that, the actual numbers of that look like? Like, you're talking about buying down $2 million. Like, what does that mean? to the normal person that may not, and that's me too.
Yeah. No, so that's essentially wherever the rates are starting at. And for conventional and for your Fannie, Freddie, all of that, so wherever the rates are starting at, and that fluctuates, that changes every day, changes within the day. So let's say that the top tier rate right now for conventional is at 8%.
So is that, let's use some real numbers. Yes. Where are we? We're in February 2025.
So I'm not sure where the top tier is today, but I do, like, wherever it is, we're having to buy down, and it's costing us about 9.6% to buy the rate down to 5.5% interest rate for. Yeah. So we're having to spend almost 10% of the loan amount, 10% of the loan amount in order for the investor to capitalize on that 5.5%.
So you're essentially offering a discount on the property. It's really what it is.
Right. Absolutely. And it's kind of depends on how you want to, and that we do pass some of that cost along to the investor by increasing the sales price so we can shoulder some of that. It's about a 50-50 split on our bottom line, and then passing that to the investor. But if the investor does choose to purchase cash, we do reduce the amount. But it's essentially us just buying the interest rate down in bulk, and us saying, hey, we only lock it for a certain amount of time. So we assume all of the risks.
So what happens? So you're buying it down in bulk. Like, what's the bulk? Like, what is that? Is that so many properties? Is it
so much
amount?
It's an amount, and then it's only for about 30 to 45 days. So we have to get those properties closed within that amount of time, and either pay a extension or lose the money that we paid.
And you're completely allowed to say, I don't want to answer any of these questions, because it's really more out of curiosity. What kind of volume are you guys doing right now? Like, we're in February of 2025. Where how did you finish out 2024?
So last year we sold 267 properties.
Okay.
And that was both on the reno side and the new construction side. So that was our total amount properties sold. Now the year prior to that, we were right at 200. I think we finished right at 199.
Okay.
So we did see a significant increase. And again, battling inventory issues as well. You know, we've not been any different than anyone else in seeing a lot harder just to acquire inventory. And we saw a lot of relief in 2024 as that.
How so?
Just being able to acquire. Foreclosures increased quite a bit, allowing us to purchase from courthouse, which is kind of how we started purchasing, and that's been tabled a good bit. I know that there's a lot of financial institutions that are holding assets just for fear of litigation post-COVID, and so you're starting to see some of that inventory finally go to foreclosure. So we're taking advantage of those, and then a lot of life happens, right? You know, divorces happens, new jobs, moves, et cetera, et cetera. So I think a lot of the people holding on to their properties with their 2% interest rates that they got, at some point it does have to give, and they need a bigger house, families change, et cetera, et cetera. So just finally being able to access that inventory. And it's been that way across the board. I think right now we're at 3 months inventory, whereas 2 years ago we were at less than a month, you know, and still the healthy market is 6 months, but so we're not there yet, but
I don't remember, going all the way back to 2012 when I got started, I don't remember there ever being 6 months worth of inventory.
Really?
I just remember it being record low inventory across the board for years and years and years. So you guys have had to deal with that, not just now, not just in the near future or the near past, but you've had to deal with it pretty much the whole time that you've been doing this. It's just, there's not a lot of inventory out there. Are there other creative ways to get a hold of inventory that you guys
I don't know that there's any other creative ways that
you guys are using the MLS.
We use the MLS.
Foreclosure auctions. I know you got your own We Buy Houses kinds of things, and so I didn't know if there's any other.
Not creative. MLS, wholesale deals, working with wholesalers. We have a lot of great partners throughout all of our markets that will bring us properties, but not necessarily any thing groundbreaking that would go outside of the norm.
I just wanted to bring it up because I want to make sure that everybody knows, Spartan has been faithful to support our group, our real estate group, for a long time, and they are actively looking for properties.
Always.
So if you are a wholesaler, make sure you're getting in touch with Spartan. I'll put all that information in the details. So we've got inventory, interest rates. Let's talk about like the property management side for a second.
Okay.
So I'm an investor and I want to invest. I want to buy some houses in Birmingham. I want to come to Spartan and try to do something like that. What can I expect from, let's just start with, I know you guys do a phenomenal job rehabbing these properties. I've seen the finished product many, many times. You do a great job doing that. So I'm sure there's very little capital expenditures that are going to need to be done. But what can I expect if you get a tenant in place? What can I expect from a maintenance standpoint? What can I expect from a vacancy standpoint? Those kinds of things.
Gotcha. Yeah, no, those are really good questions. And honestly, if you're looking at your rental property portfolio performance, you always want to ask the property management questions. And we preached this a good bit with our investors. It's not like what you and I talk about a lot because we're more on the Spartan front end side, but the property management side, that's the key component. Right. And I won't paint any kind of beautiful picture of property management. It's hard. It's rough. It is a thankless job. But we have a fantastic team that handles it. So right now we track our occupancy several different ways. You know this, where we track absolutely everything, but we're tracking our occupancy for current 13-week, 52-week. Currently, we're right at 94%, which is a little bit lower than goal. We want to stay at that 95, and that's why we track our 52 to make sure that we consistently give a 95% occupancy. We are coming off slow season, off December. That's usually when all of our leasing and security deposits really stop. So you can expect around a 94, 95% occupancy. You can expect a maintenance ratio less than 5% is what we tend to track. We do see the overall maintenance for the older properties does tend to go up. And when I say older properties, not built a long time ago, but people that purchased with us a long time ago, back in, your 2016, 17. It's not typically a lot of CapEx items, but, it's usually tenant damage with tile and stuff like that. So it's usually around 6.2, 6.3 for houses that have been in our management for a really long time, but we're under 5% for the newer ones within the last 5 years. And now eviction rates, and I know that if you have rental property, or if you have several rental properties, or you work in property management, you know that eviction has been pretty elevated over the last couple of years. We did see that decline. We were at anywhere from like 7-8% in 2023 to back down to less than 3% last year.
Wow.
So as soon as those eviction moratoriums let out, and then judges really came kind of full circle back, there was a lot of issues, I know, for our market on just I just lost my train of thought. Sorry. No, the workforce on set outs, that was a very big hindrance on getting people vacated.
It's always been that way in Jefferson County.
It has been.
As far as I know.
It has been, but we saw it in a lot of other municipalities. It has always been a struggle with Jefferson County, absolutely. But it was everywhere else as well. So that hurt a lot. But coming out of that, 2024 was, like I said, we were under 3%. And I think that couples with a lot. I think property management companies are seeing that trend, and that, hey, if you're pushing the rental rates because of all the inflation, because of the value and how everything has gone up, if you're pushing those rental rates, you're just more likely going to throw those tenants into that eviction arena where they can't necessarily afford, because everything has gone up and stuff. So finding that balance line, that middle ground to increase your rental rate, but also not make that forced choice is something that's difficult to do. Let's see, from a renewal standpoint, we're finishing around like 55-56% for our renewals. And then from a cash standpoint, so when our tenants are vacating and we're doing turns, we average right at about 14 days of handling that, and about $3,200 on the average move out. So from a cost standpoint, that's pretty much what you can expect. And when we get asked these questions, we try to paint the average of like, hey, look, I can't tell you exactly what your portfolio is going to do, but from we have about 2,000 doors under management, a little over 2,000. And so from our portfolio, this is what we average. And I think that paints probably the best picture of how your property is going to perform by looking at our average.
Right. And then if you have one property, that makes it really difficult, because you're really not going to hit any of these averages. You could be running along perfect for a long time. You could just be, all of a sudden, you just got the person that's just not paying.
Yeah.
And so just having one really kind of dilutes that too.
It does.
Do you obviously you encourage folks to buy as many as possible. You like your repeat buyers, but is that a conversation you have with folks if they're buying one?
Oh, absolutely. In fact, we try to put incentives on the multiple purchase, but we do have so we have what we call our investor report cards, and it showcases that, hey, if you buy this one property and this happens, this is what it's going to do to your return. However, if you add this other property, it's a simple spreadsheet, but if you add this other property, look what this one work order does to affect that. And and stuff. So they're able to see like, okay, well, if I want to get to 5 properties, then you're able to lay that out and say, okay, look, this is what your property, this is what your cash flow would be if you're in this range and this rent and et cetera, et cetera. So we're able to break that down for them. And then also offer, if you buy up to 3, we give you 3% property management fees for 3 years. And then we
really,
and then if we also have this tiered kind of clubs. So we have the Warrior Club, obviously Spartan and Corinth and Atlas. So, we kind of keep it on that, the Warrior Club. And if you get to 5, you get a reduction in your property management fees. And then you get a bunch of swag. Same with you hit the 10 and then the 15 and stuff like that. So yeah, we always try to encourage our investors to build that cushion as much as possible, but never, we wouldn't encourage anyone to take on properties that they couldn't reasonably afford.
For sure. So I wasn't even going to ask this, but it kind of makes me want to ask, why single family versus maybe a more multifamily approach? Why should someone buy 1 or 5 single families and not a quad and not a if they can an 8-plex or a 16? Why would someone do that?
So I think there's a bunch of different reasons as to why the multifamily versus single family. Multifamily, there's a lot of benefits. You're able to add on doors a lot more efficiently, and with inventory being an issue and a struggle, I think a lot of people are leaning towards multifamily. With the single family, I think one of the biggest pros, and there's a lot of pros with it as well, but the biggest pro is just your exit strategy.
Oh yeah.
You're like, whereas if you're going to buy a 4-plex and rent it all out, let's say something happens and you need to withdraw your capital immediately. The amount of buyer pool for that 4-plex is so much smaller than if you had a single family home, because if you've got the single family, you were able to vacate the tenant, and then you would have the pool of investors and owner occupants in order to sell to if something terrible were to happen. Now, again, I don't want you to base all investment decisions on, hey, what if the world ended? But it is still good to know that is an exit strategy, that would be an option for single family. And then of course there's a more of an ownership consistency with tenants in single family, and that their length of stay does tend to be a good bit longer. I mean, our average length of stay is right at about 36 months. So our tenants they're getting in there, they're building it and making it their home, which you don't tend to see that length of stay as long on the multifamily. So again, there's the pros and cons. You're able to adjust the rent probably a little bit faster with the multifamily, add on the doors, et cetera. So, again, pros and cons.
For sure. Just want to get your take, because I've talked to multifamily people, and they're just, the economies of scale. It's if something bad happens, it doesn't affect, me as dramatically. But there's, like you said, there's pluses and minuses.
There is, absolutely.
I want to go back to the rents, because, property prices have been going up. Rents have been going up, and you just mentioned there's kind of like this fine little dance that goes along with, if we push it too much, now is this thing a little bit, is it unaffordable now for the goose that laid the golden egg?
Absolutely.
That's I was always taught in the beginning, you got a tenant in there and they're paying.
Don't touch
You
them.
don't want to disrupt that.
Right.
So what does that conversation look like with a potential, investor? They buy a property and you've had a good tenant for a few years. They want to increase their, their cash flow, obviously, but you also don't want to upset that goose that laid the golden egg. So how do you kind of balance those rent increases?
And that's a really good question. And we have those individual conversations. So kind of our rule of thumb is, so if you've got a property, we sign 2-year leases up front, or they have to pay more for if they're doing 1 year. So when they're signing their 2-year leases, so that locks them in. A lot of people ask, like, well, don't you have a problem? Like, don't tenants not want to sign? It's like, no, they're locking in their rent for 2 years. They are all about wanting to do that. So that's not necessarily an issue. The average increase year over year is about 4%. And we're not looking over the last few years. We're looking historically. So if the investor doesn't want or doesn't really care about the next rental increase, after the first 2 years, we're going to try to push it to that 8%. We're going to try, that's our goal right there. Now we do take in other considerations, is that, hey, does that 8% push them over what we think the market rent says it is? How well have they been? However, we do have, thanks to Zillow and investors looking and doing some assessments online, they're like, well, Zillow says this house will rent for $1,500. It's like, okay, well, this is a 3-2 in Hueytown. So let's look at other factors. You've got a great paying tenant, et cetera. Now, if the tenant has performed really well, we strongly advise the investor not to try to increase. But at the end of the day, it's their call. It is their decision if they do want to do that. But we say with full, and sometimes if it is even higher, if they want to place that property on the market for way over what the market is, sometimes we make them sign something saying, hey, you're not going to hold us responsible for this property sitting here vacant because you're putting it so much higher than what we feel like we can get.
And even 1 month extra of it being vacant would negate all of what you just could have gotten if you would have just taken.
You're talking about the tenant move, and then how much it's going to cost to get that property back in shape, and then not to mention the releasing fee, right? Because we have to, if we're having to go in there and then remarket it and release it, we charge for that. That's 1 month's rent if we get a 2-year lease. So you've got all of those costs associated with it. And then what happens if your next tenant, you could push the rent to $1,500, but is the next tenant going to be able to afford that for any length of time? Or is it just going to be like they're going to be able to afford it for 6 months and then you've got another vacancy issue? Yes, if you have a paying tenant, again, if they're a paying tenant and their rent is $600, then yes, increase it. Sure. But don't jump it, $800 in the first swoop.
So I want to also ask you about, you mentioned Hueytown, you just threw it out there, but I did want to talk to you about specific areas.
Okay.
And I'm sure, look, you guys are obviously, I know what you buy. You're buying in good areas. You're buying in areas that are going to cash flow. I get that. But where have you seen and let's just stick to maybe Jefferson, St. Clair, Shelby. So I know you guys do a lot in Tuscaloosa too. So let's just kind of stick to those kind of greater Birmingham, central Alabama counties. Where are you really seeing growth?
That's a really good question. I think that the areas that we are trying to target, not necessarily that we've seen and experienced the growth, we've seen the jobs come, because that's where, and honestly, it's been in that southern, your Bessemer, McCalla. There has been a lot with the Smucker's plant, the Amazon. There has been a lot of higher paid manufacturing jobs. Mercedes continues to grow, and so that's going to feed into that little sub area. So that particular area we've seen, so the south of Birmingham, and then also the same to the north. And I think that we're going to continue to see those areas like Coleman and anything that connects Birmingham to Huntsville. As those two metros continue to grow, you're going to keep seeing the growth, of course, through 65 with your Fultondales and Gardendales, and then your
even like
Coleman, Morris, Kimberly, all of those areas have done very well for us.
I think the last time I asked you that a couple of years ago, you said Vance, and because obviously Mercedes is there, but that whole, you're talking about that McCalla area, which a long time ago I actually lived over there. So I know that area very well. I remember when all those jobs came in, all those plants came in. So McCalla, Bessemer, sell me on Bessemer. Bessemer is kind of like street to street, pocket to pocket.
Very street to street. So Bessemer, you do have to be wary in that there's a lot of areas of Bessemer that we don't currently purchase in. So when I say Bessemer, like the Bessemer, Hueytown, McCalla area, I mean, you're talking about like where the new UAB West is, like that just opened last year, so all of those in that whole area going commercial in, I would say right off the 459, that area. So if you've got 59, 459, all that kind of corner of Bessemer, Hueytown is done really well. The Hopewell, where's Eastern Valley, not necessarily in your downtown Bessemer, right off 59.
Interesting. And then I also like to get your take on, and then I feel like this is a long way away, but that northern belt line where they're trying to connect some stuff up there, Trustful to I-65 that you just alluded to. Is there any opportunity there in the near term, or is that still maybe a 3 to 5 year play?
For that, like right off 22, I mean, I think that there's a lot of potential for growth there as well. Connecting, if you do connect that, what is it, to 65 to 59, the same that 459 did. I mean, look what 459 did to those particular areas. So it's got a lot of potential. I don't know where they are on the time frame, because I know that project was approved a long time ago.
But they just, you're right, but they just actually started back on it. So, and that's what I'm saying. Is that more of a 3 to 5 year play, or is there an opportunity there now, you think? You guys aren't really seeing any properties up there.
No, we see properties kind of really everywhere. We've got a pretty decent amount of rental properties in Jasper, and I think that the Northern Belt line, is that what they're calling it, or loop?
Yeah, Beltline. Yeah,
Beltline. Yeah. That it'll help Jasper as well. It'll help anything off of that I-22.
Yeah, 22 being finished. I know it's been a long time.
It will help. Yeah, absolutely. And so I think there's a lot of opportunity. I mean, we haven't necessarily seen it, so I would probably agree in that it's a more to 3 to 5 year play.
Okay, so Birmingham and then Huntsville. I think everybody, the secret's been out on Huntsville. Huntsville is just exploding. You're building to rent. Where are you guys building to rent right now?
Building to rent. So we are wrapping up our neighborhood in Tuscaloosa. It's Hacienda Place, and right off 73, exit 73, just a little past the 76 exit for McFarland. 73 that's right.
McFarland. Yep.
Oh, 73 is McFarland. So we're 71. Sorry.
Okay, so 71. So past.
So a little bit past
359.
That's where our neighborhood, or that's the best way to get to our neighborhood. And we've got 12 properties left, and they're set to close this quarter.
Oh, wow.
Then we're done. That was a 70.
They're already bought? They're
already gone.
Okay. So what's the next?
So our next one is actually in that Bessemer McCalla area. We're just waiting on permits, and it's right by the UAB West.
Wow.
And it's hard to quite 100% show where it is, but it was a neighborhood that was originally started. Phase 1 was done, and then we're coming in and purchasing phase 2. They're lot ready, so we're going to start going vertical. And then we also have, this is not a build to rent, but we're doing some townhomes in Helena, and that'll be just owner occupants as well.
Take me through some of the numbers in Tuscaloosa. Like what are these sales prices, rents, things like that? I'm just curious to know.
Yeah, no, absolutely. It's good.
And then what are you projecting investment?
Okay, so they're very, very different because the Tuscaloosa deal, it was one of those deals, like we bought the land in 2019 and started developing before everything blew up. Yeah. So our cost in it is kind of a joke, right? Like it was just a great deal. Now it would have been just a slam dunk if sales hadn't slowed down as much as it did. But it's been right now our average is anywhere from like the $240 to $260 price point, with a rent of $1,650 to $1,750.
Okay.
And then property taxes in Tuscaloosa are very low, and then of course insurance on new construction is
probably
a lot lower. Yeah, it's a lot lower than it is on renovated properties. So, I mean, if you're buying these with finance, if you're leveraging to purchase the properties, you're going to get anywhere from about a 6.5% to 7% return for the first year. Yeah. Of course, that doesn't take into account appreciation or depreciation or anything like that. But those are about the rough numbers for the ones in Tuscaloosa. Now, the ones in Bessemer, we're doing, it's a little bit of a bigger footprint. It's a little bit of a bigger house. The lots serve, and so does phase 1 is more single family homes. So we're going to be building a little bit of bigger house and selling those for about the $290 with a $2,000 to $2,100 rent.
Wow. Very nice.
Yeah, so it's very different than the first project. But again,
I would have thought opposite. But I know there's so much growth right there.
There's a lot of growth, but again, also at the just timing of purchase. When we purchased the land in Tuscaloosa, it was, again, a first phase. We came in, the first phase was almost complete. There was about 13 lots in the first phase that didn't get completed during the 7 to 9 recession. And we came in, purchased those, and then the owner of phase 2, 3, and 4 reached out and was like, "Hey, do you want this?" And we had no plans of being developers, but it was such a great deal that it kind of blew up.
You find yourselves wanting to do more of that?
Absolutely, yes. We've seen a pretty decent demand in the new construction side for rentals with investors for several different reasons. Like some people prefer the price points of the renovated properties, but with those prices increasing, I think investors are more opting to buy new construction if it's anywhere in that vicinity of price, they would rather just get the new build.
Yeah, for sure. And I was seeing that. That's obviously not just Birmingham.
Right.
That's
kind
of been a
fad.
fad.
That's been a fad everywhere. Yeah.
So why, I want to know why an investor would buy a turnkey, or why is someone coming to Alabama to buy a property? So we've seen record appreciation that we've never really seen in Alabama before, which I don't know that it can continue, but we've seen record rent increases. So you've got great cash flow advantages, tax advantages. So you've got all these different, obviously the principal pay down, there's all these different reasons why someone might park money in any turnkey property.
Right.
Why are you seeing with your investors, why are they coming to Alabama?
I mean, I think for a lot of the reasons that we just talked about, as far as just affordability, your cost of living, of what makes Alabama a good market to invest in general. There's growth, and there's the landlord friendliness of Alabama, which I can't stress enough to.
We'll talk about that. What do you mean by that?
Well, if you look at where majority of our investors are those wanting to invest outside of their current state, right? Because if you're let's say you live in Tennessee, then you're probably more likely going to invest in Tennessee. If you're living in one of these Southeast markets that have become so desirable with rental properties, then you're going to probably opt to try to do it yourself. And so if you're looking to purchase turnkey, the full service kind of with Spartan, why Alabama is that you're Colorado, California, all of these states have implemented and enforced this very anti-landlord approach and laws. And it's difficult to do property management in just the normal course, and then where it's taking you 9 to 12 months just to evict a non-paying tenant. And just imagine what that could do to your return, to your cash flow. It's non-existent, all the while shouldering your lawyer's fees and the cost of the property, and then any kind of damage that they do. So there's several reasons that kind of set Alabama aside. Governor Ivey's just recent crackdown on what was it? There was such an increase with the Airbnb and squatters rights. I mean, that's huge, and we've come across that prior to this move of crackdown. We've come into situations where we've had people break into a vacant property and take one of our leases off, try to get a copy of a lease and try to put our logo on it and say, hey, no, I rent this house, and the cops are like, well, this is a civil matter.
Right.
And it's like, well, it's not. They're trespassing. So that change has already been very helpful in securing properties. And so it's little things like that are going to help Alabama or set Alabama apart in making the area just more desirable for investors.
Yeah, for sure. There's a lot of what I'm seeing too. Anything else? What did I miss?
That was a lot. I don't think so. But yes.
You got notes here. Is there anything you wrote down? Okay, I didn't know if you have any notes. I'm trying to think, make sure
I've got notes, but I think we covered everything.
Okay.
Yeah. I think we covered all that stuff. Market, future, yep.
I just did all that off the top of my head.
That was great.
I know I forgot something though.
You'll remember it right when you hit end.
We'll have to do it. We'll have to do another video. I love talking to you. You're so knowledgeable, and not just because you're smart, but because you're in it. You've been doing it for so long in our area, and it's always a pleasure to speak with you.
Thanks, Brian, thanks for coming to our office and setting this up, and I appreciate it.
Thanks, Lindsay.
All right, thank you.
All right.